Continue chapter 10, that is sources of finance. Today I'll be discussing the concept of public deposits, then the loans from commercial banks, that is term loans, cash credit, discounting of bills of exchange, overdraft, trade credit, and intercorporate deposits. So you need to know only the meanings of all these terms. So let's begin. Public deposit. Public deposit refers to the unsecured deposit invited by companies from the public, mainly to finance working capital needs. That means it is one of the method of raising capital. A company wishing to invite public deposits make an advertisement in the newspaper. Any member of the public can fill up the prescribed format or form and deposit the money with the company. Company in return issues a deposit receipt, that is a proof of deposit. It is also known as the acknowledgement. So this receipt which the company gives against the deposit made by the public, that is an acknowledgement of debt by the company. The terms and conditions of the deposit are printed on the back of the receipt. The rate of interest on public deposit generally depends on the period of the deposit and the reputation of the company. Generally, the public deposits are invited for a period of 6 months to 3 years. This is a standard term. Therefore, public deposits are primarily a source of short-term finance. However, the deposits can be renewed from time to time. Renewal facilities enable company to use public deposit as medium-term finance. Public deposit of a company cannot exceed 25% of its share capital and free reserve. As these deposits are unsecured, the company having public deposit is required to set aside 10% of deposits maturing by the end of the year. The amount which is set aside can be used only for paying such deposits. Thus, public deposit referred to the deposit received by the company from the public as unsecured debt. Companies prefer public deposit because these deposits are cheaper than bank loans. The public prefers to deposit money with well-established company because the rate of interest on public deposit is higher than on bank deposit. Now, the public sector companies also invite public deposit. It has become a popular source of industrial finance in India. Various types of loans from commercial bank. First is term loans. Banks now offer loans to business firms for medium term. Loans are generally secured by assets or guarantees. The borrower may be asked to repay in lump sum or in installments. Next type of loan is cash credit. It is a formal and revolving credit agreement under which the borrower is allowed to borrow up the specified limit. The amount may be withdrawn in installments. Interest is charged on the amount actually withdrawn. The borrower is required to offer security in the form of tangible assets or guarantees. Discounting of bills of exchange. This implies procuring cash from a bank in exchange for credit instruments. Commercial banks provide short-term finance to business concerns by discounting their bills of exchange, promissory notes, and hundies. Banks charge some commission for this service by paying a price lower than the face value of the credit instrument. The holder of the instrument remains liable to the bank if the instrument is dishonored on maturity. For example, A and company sells goods on credit, and bills of exchange is only meant when the transaction is done in credit terms. So A and Company sells goods on credit for rupees 50,000 to B and Company, which signs a bill of exchange due after 60 days. So the maturity period is 60 days. A and Company can get the payment of the bill from a bank. It can get the bill discounted from a bank before the 60 days, that means before maturity. So he has to approach the bank, it has to approach the bank. The bank will deduct some discount to cover interest charge for 60 days. On due date, bank will receive payment of the bill from B and Company. Bill discounting is different from overdraft. Next is overdraft. An overdraft is a kind of a temporary financial accommodation extended by a bank to its regular customers. Under this agreement, a customer having a current account with bank is allowed to withdraw or overdraw his account. A business enterprise can enter into this agreement to take care of a temporary shortage of working capital. Interest is charged on the amount actually overdrawn and not on the amount sanctioned by the bank. Trade credit. Trade credit is the credit extended by one business firm to other for purchase of goods and services. It is also known as mercantile credit. Trade credit may be defined as credit extended by sellers to buyers at all levels of the production and distribution process down to the retailer. It does not include consumer credit or installment credit. It arises out of transfer of goods and is unsecured. Trade credit is usually granted for a period ranging from 15 days to 3 months. The buying firm receives supplies without paying immediately. Trade credit reflects the buyer's power to purchase now and pay later. It also indicates the seller's faith in the buyer. It is available in ordinary course of business and no security is required for getting it. The amount and terms of credit available depends upon the financial strength and goodwill of the buyers, the custom of trade, financial resource of the supplier, the amount and frequency of purchase, degree of competition in the market and location of the customer, the nature of product. Trade credit does not make available the funds in cash. For example, A and Company purchases goods on credit from B and Company for 50,000 on 3 months credit. This means A and Company's requirement for working capital for 3 months is reduced to the extent of 50,000. Additional credit can be generated by increasing purchase volume and extending the credit period. Is intercorporate deposits, which is also known as ICDS. Intercorporate deposit is a deposit made by one company with another company for a short term, say up to 6 months. The ICD is generally unsecured debt and is arranged by a broker. It is a popular source of short term finance as it is convenient and free from legal formalities. The ICD is not disclosed to the public and the secrecy of the borrower is protected. The rate of interest on ICD varies depending upon the amount involved and the time period. The entire working of ICD market is based on the personal connection of the lender, borrower and the broker. We come to the end of this chapter. Next class I'll get back to you with the questions. I'll discuss important questions and the answers. So till then, have a good day. Thank you.